All right, so welcome everybody. We are here tonight to talk about where to find the money and how to fund your investment deals. So before we jump in, we'll do some introductions. So
Tom and I, hey everybody, I'm Joanne Curtin. Tom and I, we started real estate here in our town of Roswell, Milton, Alpharetta. Well, in Roswell originally is where our office is in Roswell. And we started our company 20 years ago this summer. And we originally got into the business because our big why for each other was to grow wealth through real estate. And we had big goals, and the way we were going to get there was through real estate. There was no doubt about it. So that's why we're here. This is like our big love. I mean, this all came out during COVID. We were like, where would we want to spend our 7 p.m., on soccer and dance evenings? We're down here, in the basement teaching about building wealth. So we love it. This is kind of what our jam is. And I'm still in sales, been doing sales. I love sales. And so, I'm kind of in charge of sales on the team. And that's just what I know. And I'm looking for, great, obviously, listings to sell to all these people that we have lined up. So that's kind of the side I'm on. I put on my listings hat when I'm on a lot of teaching site classes, because we're looking for ways to help people think about resale or wholesale or being an investor, right? So, and then Tom really works with, well, I'll let you speak, Tom.
Thanks.
Okay, sorry. I can speak for you. Easy. But...
So, yeah, Joanne and I have worked together now for 20 years, and I have focused more on the investment side, from property management to analyzing deals, finding the deals, and then just supporting Joanne in the background with our sellers, kind of maximizing their value. But really, property management, again, investing, running through deals. So I'm always happy to help look at deals, even if it's not something that we're involved in. I just enjoy running the numbers and figuring things out from that standpoint.
Mm-hmm.
And then, again, working with some clients on property management side, helping folks with leases, structuring that kind of stuff. So,
Mm-hmm.
And then tonight, Chip, I'll let you introduce yourself. We've got Chip joining us. So,
thanks for having me, guys. Really appreciate it. It was great to meet some new friends down in Georgia. My name is Chip Sher. I am the founder of 4SB Partners, and I am in private lending. I've been in the private lending space, a bunch of different roles, but really for about 30 years. And interestingly, I, like a lot of folks, I kind of fell into this side of the business. And once you're in it, it sort of captures your attention. And I kind of live it and breathe it day and night. I can't put it down. But so long story short is I was selling real estate when I started right out of college, and market was lousy, and I was young, so I didn't know anybody that had any money. So I had two choices. I either had to figure out how to be creative to get stuff done, or I was going to starve. And I didn't like the second option, so I figured it out. So we started piecing different projects together using private money, and one thing led to the other, to where I was now locating different sources of capital and then helping borrowers marry them to the different sources of capital. That's really sort of the genesis. But anyway, I'm thrilled you guys are having me, and I'm looking forward to the conversation.
Yeah, great. Cool. Look forward to learning from you a lot. Thank you. Okay.
Okay. If anybody else wants to introduce themselves, they can. Otherwise, we're going to just jump in. So.
And you don't have to raise your hand. You can just say something.
Or type it in the chat. Yeah. So we'll watch the chat. Cool. Legal stuff. So I think the gist of this is that you should vet your own deals. We're not lawyers. We're not attorneys. We're not CPAs. So what we provide here is just trying to be of help, but it's not a substitute for legal counsel or CPA counsel, right?
Great.
All right. All right. So,
All right, so you found a deal.
yeah. So in the
I
past,
like to find deals and then throw them at Tom.
so, yeah, in the past few months, we've talked about, how to find deals, right? And then we've talked about how to analyze costs to renovate the property and figure out values and cost of renovations and all that. So we thought the next logical step would be to talk about finding the money, right? And how do we fund the projects that we find after we figure out all the other stuff. So I will say right now, I would say, well, I say right now, but I think anytime really the opportunity is find the deal and the funding and the money will come, right? So it really starts with that. And I'm sure Chip will talk a little bit about this, but a lot of the funding is driven by the deal, right? If you have a screaming deal, you're not going to not be able to fund it, right? It starts with that. So if you haven't watch that one, go back about finding the deal, or we can talk offline about that, but that's where it all starts. So possible sources, we're just going to touch on some of these different areas. Cash is, I guess, the obvious one, easiest and cheapest. If you have the cash to fund a project, then you can certainly do that. I would just say, unless you have a ton of cash, you might want to think twice about putting all your own money up, and that really goes into a couple of things. One is your return on your cash, right? So if you're funding it completely versus only putting a portion of it in, your return on your capital is not going to be as much. And also, you might potentially be limiting yourself from being able to do other projects. If you find one deal and you put all your cash or all your eggs in that one basket, even though it might save you a little bit of money, what is it really going to cost you if you then have to turn down a really good next project because you're all tied up in this one? So, so it is the easiest, but not always from a return standpoint, the way we would recommend you go.
And home equity stocks and other investments.
Yeah, so I would kind of separate out home equity. I do think is a good opportunity, especially right now with the values having gone up and the rates where they are. Just doing a HELOC on your personal home, if you have it there, that money is relatively cheap, is definitely cheap. And it gives you the opportunity to just use it if you need it. So, let's say you've got enough equity to put $100,000 or $200,000 line of credit HELOC on your home. I would say, why not, right? Why not have that as an opportunity there? And then if you need it, you use it. If you don't, then other than some pretty minimal cost to get it in place, it's not costing you anything. Stocks and other investments are an option. It does require you to potentially sell them, of course, to use them. So timing wise, sometimes that's good, sometimes it's bad. IRA, I think we could do a whole
we could get off on tangents with the IRA.
A whole night about self-directed IRAs. I think that is a good option. Again, we're not going to get into all the detail of the self-directed IRAs, but it is it's an opportunity that I would recommend you look into, and we can probably talk more about that at a later time. So,
So Tom, I would, before we sort of move on to the next one, and we can talk about how you utilize your IRA and some tips on HELOCs and what to do and what not to do. But one of the things that I always tell investors first meeting, the first thing they need to be able to calculate is ROI. They need to know what that means. They need to know how to calculate. And that's simply is if you buy a property, and let's use real round numbers. Let's say that the total dollars invested are $100,000,
Mm-hmm.
and you get done with that project and you make $20,000.
Mm-hmm.
Right? So you put up 100 grand, you made 20,000. Calculating it, you're taking $20,000 divided by 100,000. It's going to equal 20%.
Mm-hmm.
Okay, that's not bad. But the way you really want to calculate it is you want to look at the time value. So if you did that investment and you were able to make that from end to end in 6 months, figuratively, you could do that twice a year. So you could take that $100,000 and make that same investment twice, and at the end of the year have 140,000. So you'd make 40% on your money.
Mm-hmm.
But the important thing is to go into a transaction and be able to analyze how much cash did I put in, and then what did I make. So if you take that same $100,000 transaction, and let's say you put up 15 grand. So look at that math. You put up 15,000, you got back 20,000. Okay,
Mm-hmm.
that's 135% return in 6 months.
Right.
Annualized, it's 270% return.
Mm-hmm.
And where it gets interesting, and by all means, we're not talking about doing this your first time through. But where it gets interesting is if you took that 15, so you had 100,000, and you could do 7 transactions with that 100,000, and you have that same return times 7. That's where you get scalability. So the first thing I want people to think of is you have to know your numbers, and you have to be able to analyze what your ROI is going in to make an educated decision about what next steps are and how you should approach it. A lot of this is risk tolerance. There's risk in anything. I always tell people, it's like, look, the water is cold and it's wet. Okay. Only way you're going to get to the other end of the pool is you're going to have to go back 15 steps, get a running start, and jump in that water and start swimming. So there is something to be said about analyze, and do nothing. You never get anywhere. At some point, analyze, go do it. And you're going to learn so much from doing that deal. You still need to be educated. You still need to take a well-formed opinion of how you're going to take on this transaction and do it the right way. But you learn from doing. I think you guys can probably attest to that in your real estate experience.
Absolutely.
It's not in the textbook.
Yeah. And I'm so glad you stopped me, because Joanne always says I go too fast through things. But I think to emphasize your point, when we're talking about flipping a property, that annual number is so important to calculate, right? I think that's where, when we've turned something really fast, there's so much value in that, right? Because in people's mind, they don't always do it, right? Because they hear, oh, I made everything that they read, like the stock market, stock returns, interest rates it's all annual, right? It's an annual number.
Right.
So when you stop and annualize it, right? If you can do something in 2 or 3 months,
right,
and
then it starts to get really interesting.
Yeah, 15% in that time. Then what is that annually, right? When you take that out on an annual basis, that's huge, right? So to your point, that's why we try not to use cash, right? If the deal makes sense, is because we want to be able to do multiple deals, right?
Multiple deals. And one of the important parts of that calculation, guys, I'm speaking to investors out there, is your lender, whoever that lender is going to be, wants to know that number. And they want to know that you're going to make money on this transaction. Because at the end of the day, if you're not making money, at some point, there's no longer a profit potential for you to follow through on what you're supposed to do. However, if you can show them, I've done all my homework, I'm going to do all of these following things. When I get done with this, I'm going to realize a 75% ROI in 6 months, annualizes 150%. And they're like, okay, you've done your background research, you know what you're talking about, you're committed. Partially what I'm telling investors to do is to speak the language of the lender. Because if you're speaking their language, then all of a sudden there's you're coming from the same wavelength.
Mhm. Yeah. Yeah. I think
I run into that with contractors where they know square feet, right? But they don't know ROI, right? So they can tell you how many nails go in that house and how much drywall and what the paint contractors, but they can't tell you the calculations. And that's if you find a flipper that's also a contractor, having that skill set is very, very valuable because now they can speak on both ends.
Mhm.
Yeah.
Yeah, totally. All right. So other sources, friends, families, partners could be a good option. Split on profit for a partner offer high. Often we're going to get to other opportunities. So if you're having to split your profits, that can take away from your profit, but it can also add complications with friends and family. So I would just make sure, we've done group deals before, and knock on wood, that's all gone well. But we made money, right? So I always thought about, well, what if we didn't make money? Then how well would this have really gone,
Yeah.
right? That's when I think you could get into trouble, or if something takes longer than anticipated, and one of your partners now wants to liquidate, what happens then? All those things, can add complications to it. And that's why, we like folks like Chip that can cause us to not have to bring in partners if we don't have to. So,
yeah, and I can talk you through the whole partner thing too.
Okay.
I've done a lot of that stuff. A lot of that, the devil's in the details, and it's all about the structure.
Mm-hmm.
So typically, you'll have an investor that will come in and say, "Okay, you got the deal. I'm going to put up all the money.
Mhm.
You're doing all the work, and then we're going to negotiate a split." So there'll be a brand new LLC typically, and you guys are going to negotiate member interests. So it's basically who has voting rights, who's going to get the payouts, all that good stuff. And it's all absolutely negotiable. Typically, an investor is going to want to say, all right, I want a preferred rate on my money, nominal. I want a rate like it was out on a loan. And then I want some kind of bonus because I'm lending all of the money or I'm putting up all of the capital. And if you have a friend and family and you can negotiate a deal better than that, good for you. But what you're going to find typically on a joint venture deal, even if you're talking about a big development project, right? There are equity partners that would come in and they'd say, okay, while I'm in the deal, I'm going to get X amount preferred rate. That money comes out first before anybody makes any money. The investor gets their money back and they get a preferred rate. Whatever is left is split based upon whatever you agree on. And it's all negotiable. But what's fair about that is the guy that has money to lose, they're getting their money back first with a return. And it's only fair.
Yeah.
Yeah.
High risk,
Yeah.
high reward.
So Chip, let's run through an example of if you were let's say you were just a new investor and you found a deal and you wanted to bring a partner in to do, and you were going to be the hands-on guy that kind of ran general contractor and oversaw the project and all that. You had, the rich uncle, right? Like,
rich uncle comes in and let's say the project's $100,000. Okay, this rich uncle puts up 100,000 and they're going to form Rich Uncle LLC. All right, and under the LLC, the rich uncle, the actual member interest and who owns what percent is totally negotiable. But in the terms of the LLC, the rich uncle would get their money back first at a preferred rate. Let's say it's 8% for however long it's out. So it's out 6 months. 8% for 6 months on 100,000 is, I don't have a calculator, but
600 something a month.
Right. It's $800 a month times 6, so it's basically $5,000, right? So they get that money out first, and let's say there's an additional $20,000 of profit. Then that amount is split based upon whatever you negotiate. Typically, if I am doing all the work, I may say, okay, I'll get you your money back first at a preferred rate, but then after that, I get 60-40 split in my favor, whatever you negotiate.
Mhm.
At the end of the day, you look at what did you bring to the table. The other thing I would say is we're talking about ROI. What is your ROI if you put up $0?
Yeah.
It is infinity.
Mhm.
You can't calculate it. You're getting a return without having to put up any money. So anytime you can get that kind of deal, and where I see that most realistically, the newer investors, if they're doing a deal like that, it's with friends and family that they know and they trust them.
Right.
With the privates that I know, they'll say, look, your first 3 deals, I want to do a regular loan for you, just a regular old loan. However, after we've done 3 and I know you and like you, I know that you perform, if you call me on the phone and you say, oh, your money's tied up, you need 100% financing, okay, let's talk about a partnership.
Mhm.
I will tell you one of the things that we had talked about before, your other options with your HELOCs and your IRAs, all that other stuff. What that allows you to do is to create some liquidity so you don't need a partner. You have an opportunity, you can make $100,000. Why do you want to give away half the profit to somebody for putting up the capital where you can borrow money from a myriad of sources so long as you can source some degree of down payment?
Mhm. Yeah. 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 Okay, so next, loans cost more than cash, but are often the best combination of speed, leverage, cost, and convenience. We're going to talk about, I guess, different kinds of loans here. Somebody
Yep.
type something in the chat. Let's see. Oh, that's Michael. Hey, Michael.
Hey there. I shared my personal link with everybody on Meetup.
Oh, that. I thought you were just logging in multiple times, but thanks for doing that. What's going on?
Not much. How are you?
So the link that went out, you said nobody could get in with it?
Yeah, they couldn't get in on Meetup, so you see me logged in like 10 times.
Okay. Thanks for doing that.
Yep, you bet.
All right. Okay, so let's talk about loan sources, starting with just traditional banks. So I think what we're talking about here would be either a commercial line of credit, or if you're going to hold a property long term, like a rental property, then I think you would probably use a traditional bank to do that.
Yeah, there are other options available now, but I certainly think, and if you're talking about a traditional bank,
Yeah.
what I think of in this space is your local community bank.
Mhm.
Right? It's not going to be Wells Fargo. It's not going to be Bank of America. It's going to be the local community bank that knows and understands the real estate.
Mhm.
And they are going to look for the reason that a lot of investors won't use the community banks, or they are going to look at your income information,
Mhm.
and they are going to be running ratios to some extent, just like a
Right.
traditional lender. So you
Yeah.
have your personal residence, and now you have this investment property, particularly once it's fix and flip, there's no income being generated from it. They're going to take that debt against your income and make sure that you qualify.
Right.
So the qualifications are more stringent, and also the documentation, it's probably a 2-month process. So it's just something to be factored in. If you have 2 months to close, then certainly the terms are better with the bank. There's no question.
Right.
I think one of the things you want to think about with community banks is that's aspirational.
Mhm.
I have a lot of investors that, man, they've been doing it for 8, 9, 10 years, and they have enough of a track record where the community banks are coming to them.
Mhm.
And they're all saying, hey, what if we extended you a $2 million line of credit? By the way, it's not a traditional line of credit like you have on your house. They're going to basically give you a warehousing line. They're going to say, we're going to give you $2 million so long as it doesn't exceed 75% loan to value on the property or a certain amount loan to cost, so that you have money in every project.
Right.
So they're not just writing you a blank check, or you can't just, take a check from your line of credit and just draw on it whenever you want. But the terms are absolutely better. It's just going to be a little more stringent in terms of documentation and in terms of the time to physically close on the property.
Yeah, and the time could be, the difference between getting a deal or not getting a deal.
No question.
Right. Sometimes these are like, well, we'll sell it to you at X if you can close in 2 weeks. And that's probably not going to work with a traditional bank unless you already have that established line of
Yep.
credit.
Yep.
Yeah. Cool. Okay, private or hard money loans. That certainly is up your alley, Chip. So I'll let you dive into what. So I guess starting with just that terminology. I mean, I'm sure
Well-
people have heard hard money loan, and
Yeah.
maybe they have a certain connotation, or where does that come from?
Well,
And-
what kind of person is saying, I need a hard money loan? Like,
Right.
who does, what's that person thinking? And what do they need to have? What's the problem they need solved?
So typically, and I use the term private money. So, and the difference between the two, there really isn't one.
Right.
But if you go to like any of the meetup groups, they'll say, look, a private money loan is an individual writing you a check.
Mhm.
A hard money loan is a organization formed to do the same thing that private individual is doing.
Mhm.
So it is kind of the next generation. So historically, and again, unfortunately, I go back a long time. It's good and bad, right? Historically, these kinds of loans were done by wealthy individuals that made their bones in real estate. And now they're at a point in their lives where they don't want to swing a hammer, but they sure as heck understand how to evaluate a real estate deal.
Mhm.
And those guys would much rather earn a yield. And they're not the kind of folks that are going to turn their money over to a wealth manager. They don't trust the stock market because they can't see it, feel it, and touch it. But hey, I got a single family in Alpharetta, 3,400 square feet. Here are the comps. They understand that very, very well.
Mhm.
Okay. And that's sort of how the business originated. And then over time, some of these guys got together and they said, well, hang on a second. What if we raise money from other people and manage their money on their behalf? And they would raise money on a fund. And it was the same kind of principles, but now you're managing other people's money. So because you're managing other people's money, there became more documentation. It had to fit into a box. And then frankly, what's happened since the Great Recession and as the market started to take off, and I won't bore you with the details of how it all came to be, but there's more capital that's come into the market. Some of it is on the West Coast. Those are technology-based companies, and others are emanating from the Northeast. Those are New York-based companies that are raising money on Wall Street. And what's happened is they have seen the opportunity in the market. We have an aging housing stock. We still have a shortage of housing. Younger folks are moving back to the city. Some of this housing stock that is not, built in the 1950s is being reformatted and reused and being redeveloped. And there was not a source to handle that. So they figured out a way to raise money either from a crowdfunding platform on the West Coast or on Wall Street through commercial mortgage-backed securities, and they raise money. Now, what comes along with that is there are credit boxes. So you're going to find Atlanta metro area, there's probably 35 private hard money lenders, okay? Some of which fit the first criteria where there's just an individual that's writing a check, okay? Those guys are probably going to be a little pricier just because it's an individual writing a check and he can make his own rules. The good news is he can make his own rules. All you have to do is convince him that you know what you're doing and that you have a good deal, and off you go to closing. They can waive any and all conditions. The larger private lenders, and I'm sure you guys see their advertisements all over the place. I'm happy to share names with you whenever you need to. They're going to have different boxes. So they're going to call them
5 boxes.
right. So they're going to say, okay, you're a gold, you're a silver, you're a bronze, based upon experience. Okay, the more deals you've done, the more money you can borrow on a given project, and the lower your rate becomes. And it's simply risk driven. So if you've done 15 projects and can show that you've done 15 projects, what that means is you get into the middle of a project, and you guys know this all too well. Something's going to change. It never goes according to plan, right? I have investors that tell me, look, I'm going to give you an estimate of what the renovation budget is, but until I open these walls, I don't really know what's going to cost me. So sometimes you can get really good news. Sometimes you get really bad news. What the credit boxes do is they allow for, the more experienced someone is, they can figure out a way how to work through whatever issues arise. And as you work down from, let's call it gold to silver to bronze, those less experienced folks, just by their simple nature of not having done the number of deals, they will typically have to put more money down, and the cost of the financing will be higher. And simply what the lenders are doing, they're looking at a blended rate across. They're going to say, okay, we have our portfolio, 40% is going to be in the gold box. They're going to be at a really cheap rate. 30% are going to be in the silver box, are going to get a certain rate, and a certain percentage are going to be in the bronze box. And we're going to make, a combined yield on the whole thing. So it's all sort of factored in, but the amount of capital you need and your rate is going to be driven by what your experience is.
Yeah.
Yes. So if someone's done like 15 deals and they know what they're doing, why go hard money when you can go to a bank who's going to throw $2 million at you?
Speeds is a mitigating factor. The other thing is, a lot of times you have guys that have done that many deals. They have a complicated financial package because they write off everything in the world.
Okay.
And there's something in there that will not pass muster with the bank. And they may have a history, okay? They may have gotten caught up in COVID where they had some projects that had problems. Where I would play in that scenario is, it's back to the conversation at the beginning. I have a $5 million loan line of credit with the bank. It's all out, because what do real estate developers do? They buy projects, right?
Mm-hmm.
And all out, they're working on their projects, and guess what? They found another one.
Right.
A deal just fell off the back of a turnip truck, and it's the best deal in the world, and they have two choices. They can pass on the deal, or they can find a hard money lender, because they don't have enough of their own capital to just do it themselves. And I'll go to those guys. I'll be like, look, I don't mind if I'm your second or third choice. I just want to be one of your choices. And you may need me just every now and again, but frankly, the relationship, because you network with folks, you may find somebody that is not in your position that you refer me to. So it all sort of goes full circle. And you would be surprised the quality of borrower that will end up doing a private money deal. Just back to ROI. Okay, if their bank will give them 75%, but they're pretty locked in terms of cash contribution, and we can put together a program that gives them a lot better leverage so that they can do more projects. Hey, if you're making a higher ROI and investing less cash in the project, it becomes a real simple decision. I go through that all the time.
Yeah.
Deadlines are more important right now than ever.
Absolutely.
Like, watch out with your deadline.
Absolutely. And frankly, that's one of the things that it's important to, and I always tell my borrowers, it's like, look, you got to be nimble, and you have to keep your eyes open, because there's going to be something that's going to happen in this transaction that you're not going to realize. I had one recently where the agent just hadn't done a lot of fix and flip kind of projects. It was mostly a residential agent. And they came in, cash offer, totally non-contingent, 2-week close. Well, the investor that will do the deal, they will only do the deal if they have a title company that they select that does the transaction, which it's a commercial deal. They're allowed to do that. And the title bring downs, the title abstracts are all backed up because of the refinance market.
Right.
And they were faced with, I'm going to lose the deal because I have a seller that's a bit of a lunatic. And they say, if I don't close, they're going to eat my deposit.
Mm-hmm.
And I spent a bunch of time with them going, okay, this happens, right? Let's take a step back, put yourself in the mind of the seller. Okay. What does he want? Well, he wants to get to closing. What's his quickest path to closing? Give you time to get the title work done. Can anybody else close if they don't have a title report? They cannot, nor should they. What does he want? He wants to know that you're going to close. Throw a little bit more deposit at him, buy yourself another 2 weeks, away you go. That's not wasted money, because that's part of what you would invest. All you're doing is alleviating a problem and taking the concern away from the seller and getting it back where it should be, on how to get this deal done.
Right.
But the answer is on the outset, they should have allowed for enough time in this environment where you're going to have some lenders are going to say, look, we have to have a before and after appraiser. Well, getting an appraiser today is challenging. So you have to sort of take that into account, that finding an appraiser that can turn around a before and after appraiser when they can make the same amount of money doing an appraisal for a refinance that's really easy. And these are harder to do. So
Yeah, I think terms right now are just as big of a deal as the money, right?
Yeah.
Like the terms are a big deal.
right, absolutely.
Yeah. So we're just going to touch on typical hard money loan terms. Hard money or private money would be for commercial uses or non-owner occupied. So this wouldn't be something you would use on a primary residence or something
Correct.
you intended to occupy, right?
Correct.
First trust deed note in terms similar to a bank.
Yep.
And then LTV, is this pretty accurate, Chip? 65 to 70% is what you're generally doing, or does it depend on the deal?
It's triggered on experience, okay?
Yeah.
You're going to see for experienced investors, it's going to go to 75%.
Mhm,
And you may see for somebody that's never done a deal before,
mhm.
you may see that go to 60.
Yeah.
And what happens is the only way to get there is for the borrower to put more money down,
Mhm.
right? But really what they're trying to do is they're saying, look, we will lend money to this person that's never done it before, but they have to have enough of their own money invested
Mhm.
so that they are fully committed, because something's going to happen that they're not going to be able to forecast because they haven't been through it before.
Mhm. So you're just mitigating risk,
You're
right?
just mitigating risk,
And that's LTV loan to value.
Yeah.
right? Loan to value.
Okay.
Yeah. So, and then is it pretty common that you would be doing construction holdbacks and draws during
Yeah.
the
So
process?
let's assume this is a fix and flip where you're going to buy and then you're going to renovate. All right. There's two aspects of the loan. There is the advance at closing.
Mhm.
Again, let's use simple numbers. You're buying for 100,000. You're going to renovate for 25,000. And let's say the terms of the loan are Mr. Borrower is going to put $20,000 down at closing. Okay. So borrower puts 20,000 down at closing. The lender is going to advance 80,000. They're additionally going to lend in $25,000 for renovation.
Mhm.
That is going to be released as work is complete. Okay. It's important to note. They're not going to just give you money and say you're going to go start construction. Okay.
Mhm.
It is a reimbursement. All right. You're going to find some that are more sticklers and some that will say, just send me pictures and I'll send you a check.
Mhm.
What they want to do is they want to pay for work that has been complete and not for work that's going to be complete. And the
Right.
day that they're out the entire loan amount, I'll have a lot of my guys that will say, send me the MLS number and I'll send the rest of the money. So it's now done and listed.
Right.
No work left to be done before
Mhm.
all of the money is released.
And that accounts for negotiating prices, so you know that that's actually going to do the work.
Yeah.
You're negotiating that
Well,
the
and
prices, and then they're going to pay you for it. You might be off in your negotiations, and then it's not enough money.
And I will touch on another point in regards to contractors. I know that's not the topic, but here's one of the things that I see with newer investors is they're so excited to get started. They go out and they find a contractor. They gave them a price. And then, I will tell them, hey, we're funding you as work is complete. And then I find out later that they went and paid the contractor a 50% deposit.
Mhm.
Okay? So here's what happens, guys. If you pay the contractor 50% of the contract price, they're now going to take your money and they're going to buy materials for everything they're working on. There's
Mhm.
no way to control it. So the 15 projects that they're working on, you're buying tile for everybody because
Mhm.
they got money now.
Right.
And the way to do it, and you may have to give them some degree of deposit because there is mobilization, there are expenses they're going to incur. But the way to do it is to incent your renovation contract, where you're giving them X amount upfront. You're now paying them progress payments. And what I will typically do is I'll say, look,
Progress payments, that's a good word.
right,
Mhm.
I'm going to
Progress.
give you a bonus because this business It's nothing other than time and budget. All right. Most of the numbers generally work. It is, can you do it on time and can you keep it on budget? That's the most important thing. So I'll say, look at your contract and offer the carrot and then also the hammer. Okay. The carrot is, hey, I'll give you a $2,000 bonus if you finish before this date. Okay. Think that's going to get their attention? What value is that to you as an investor to have a date certain that you know the project's going to be done, and now you can go to market and confidently know that you're hitting the market in the right season, all of that good stuff. Okay. And then the other thing is, the hammer is your contract gets reduced by X amount per day if you go past this date. Right. Now you can't have it one way. You can't come in and say, I'm going to now cut your price because you didn't finish on time, and not give them the alternative, which is a bonus that they're going to get an incentive if they finish early. But it's just a way. So folks will come into me with general numbers on their transaction. I'm going to buy it for this. I'm going to fix it for this. Here's what I think I can sell it for, and I can prove it. Okay, that's all great. It now comes down to, does your $30,000 renovation budget become 40 or 45? And does your 3-month renovation timeline become 6 months? Because that 6 months, now the seasons have now changed. There may be winds of change in the real estate market. You may not be in such of a seller's market at that time. Right? You may have more inventory you have to deal with. You don't know what you know, but if you can manage your timeline effectively, you can be pretty confident to look at the next 90 days and say, here's where I think I'm going to be. And it's very, very powerful to be able to predictably say, this is when I'm going to go on the market.
Yeah. There's a huge difference in real estate in 90 days and 6 months, right? And like you said, a lot can change and a lot
can change.
Does change. So,
yep.
Yeah. I like that progress. You need to recoin that phrase, a progress payment or whatever that was.
I'm pretty sure I just made, as with most things, I just made it up.
I love it.
Yeah.
Okay.
Okay. Again, continue on with some loan terms. The credit of the borrower is not as important, I think, as the deal itself, the project, and maybe their experience, right? So, do you guys normally pull credit, Chip, or?
So it's going to depend on who the investor is.
Yeah.
Generally, investors want to know, and it's predicated on how much you're putting down. Look, if you're putting 50% down, you say, I don't want you to pull my credit, they will say, putting 50% down, I don't care what your credit is. Right? I've done loans for where the borrower was an IRA. And if the IRA owns the property, they cannot personally guarantee the loan. And they cannot commingle funds. So in that particular situation, they were putting up more capital than they would under a normal transaction, but there was no personal guarantee and there's no payment. So it's all just deferred and it's paid at the end. So there are a myriad of different options depending on what you're trying to do.
Right.
But they will want to know about your credit generally.
Okay. So typically points and some interest prepaid, at closing on the purchase, right?
Yep.
And then interest rate, that's still what we're seeing, 9 to 13, or is it trended down a little bit from there?
It's certainly trending down. I will say it depends on the deal and depends on the experience.
Yeah.
If you are uber experienced for a private lender, and again, depending on what you can show, you can probably look at about 8% on a rate, and I've seen them as low as 1.5, 2 points for an experienced investor. Okay. Yeah. And then as you go up the cycle, those rates are going to change. I haven't seen anything at 13% in a long time. And when you start talking about 13 and 5, I've seen those deals. Those are frankly bailout deals. Something went wrong. There's a problem with the borrower, and you have an investor that's willing to take the chance, but they freely look at this as they are taking a chance.
Yeah.
I can only see this like just being even more and more in demand is this house, obviously housing is
Yeah.
so expensive. There's so many renters that need to not be renting,
Yeah.
and they're going to agree to an 11% loan just to get in the house when maybe a loan couldn't go through a typical lender. I mean, I can just see the population being so ready for this.
Here's the thing, and where this comes into play is in the aging housing stock in urban and suburban areas where, let's say you have a split foyer that's been built in the 70s and it's dated, right?
I've got one of those.
Right. So where it becomes highly desirable is when you come in and you gut it and you now retrofit it. It's still in a great location, but it's been highly modernized. So that becomes highly desirable. And if you take that renter and now you are approaching them and they say go out and qualify for an FHA loan, which has some flexibility on credit, down payment's very low, and it's in a price point where it's going to fit under FHA standards, you have a line of buyers out the door that all can qualify to buy that. But this loan is for the investor that's going to be buying and renovating. And again, they're solely looking at, hey, what's my ROI? And then the lender's looking at what's the exit? How are we getting out of this deal? And it may be I'm going to fix and flip. It may be I'm going to buy it, renovate it, rent it, and then refinance it. The BRRRR strategy. So when you do that and where you increase the value of the property by renovating it, the idea being when you refinance, you're refinancing based upon its market value, not what you paid for it. So if done correctly, you're getting back all of or most of your investment, and now you have an asset that's going to cash flow for you long term.
Right.
Pretty much like a construction loan. I mean, people were doing construction loans in the, coming out of the recession.
Yep.
Yeah. So I think
that's how I'm thinking this.
Like you said, Chip, to think about it as ROI, right? So people might look at this and say, well, gosh, that sounds so expensive. I'm going to pay 9 or 10%, 3 points. But again, it's meant to be a short term.
Well, it's all ROI driven, and I will have conversation with folks, and I'll be like, look, I have a private that'll do this at 8.5 and 3 points, okay? But your ROI is going to be 75% over 6 months. Annualized, it's 150%.
Right.
I'll tell you what. Why don't you let me buy the deal and you lend me the money, because you're getting a much better deal, right? Because you're the one that's making the 75% yield, So at the end of the day, the folks that understand ROI and sort of get leverage, this is going to be okay with them. The others, okay, look, there's lots of alternatives. I mean, I will tell people, the best way to go about this, if you don't own a house, and let's say you're single, you're not tied to any one location, go buy that banged up house yourself. Okay, live in it while it's being renovated.
Yeah.
Once it's all done, refinance it, pull some cash out, or every 2 years, sell it and go do another one, because you're benefiting from getting the best possible interest rates because it's owner-occupied residence. You're able to roll over your proceeds because it's owner-occupied residence, and you're not having to bear the burden of paying capital gains tax. Those are all very, very important.
Yeah.
And
so if you live in it for 2 years and sell it, whatever gain you would have is tax free, right?
Yeah.
Right.
Your primary residence.
Tom and I were actually walking the dog, and we were talking about a property we know somebody lived in it 2 years, 300,000. They just sold it. They just made 300,000.
Yep.
Tax free.
Yep. And I will tell those people, it's like, okay, I'm thrilled you made that money. Okay. But it is a moment in time. Right? It does not mean that the next house you're going to buy is going to go up 300,000 in 2 years.
That's right.
Okay?
That's right.
You need to look at how real estate has performed over time. It's a leveraged investment. It's always also a place for you to live, and it's also a tax incentive. But I had a new investor just a couple years ago, and he was really smart, really organized, had a good team. He was highly motivated, I wanted to put him on the website. This is, the picture of what you're looking for. Young guy, good looking, it's like, right out of a magazine. And his first deal, we got to the end and we had forecast it was going to sell for 5.25, and he was going to make a nice nickel. Well, we get to the end and we listed it at 549 and it ended up selling for 585.
Wow.
So he got an extra $60,000 over and above what he thought he was going to make. I put my arm around it. I was like, first of all, congratulations. I'm thrilled for you, but don't think this happens every time.
Yeah.
So that's kind of the lesson. I mean, if you do enough of them, they average out, but they can't all be home runs. I mean, you like them to be, but it's just not. It's not in the cards, particularly in this environment.
The sweet part is like somebody that lives there. Like if they're going to live there and do all that, that's awesome. Like never buy a property you wouldn't literally live in. That's a great filter to run through.
I had an investor, a younger guy, that not only did he buy it and renovate it while he was living there, then he rented it out by the room.
Oh wow!
So he was having other younger folks basically pay his mortgage. So not only did he get his money back that he put in and was sitting on a bunch of equity, but they were paying his new mortgage for him.
Mm-hmm. I love that.
And he was smart and aggressive, and it made perfect sense for where he was in his life.
Yeah.
That's
Yeah.
great.
Yeah, we talk about that all the time with our kids aren't in college yet, but certainly a strategy when they get to college that we buy the property, they live in it, they're essentially the property manager, and then they collect the rent from 3 or 4 of their friends, and at the end of 4 years, 5 years, whatever, then we can sell it, and live it or keep it, right, depending on how it's going. But yeah. Okay, other considerations. With a properly structured loan, the return on your cash is much higher because you don't need as much. So we've been talking about that, I think, all night, just the ROI on your cash in the deal. And, if you could utilize somebody like Chip, you might not need a partner or a friend and have to split profit. Then you can keep all the profit and just pay, that cost of the loan. So, and then, if you do need to bring in a partner, finding somebody with 50,000 is obviously easier than having to fund 500,000 if you're trying to pay cash for the whole deal, right? So,
yeah, that's a great point.
Yeah. All right, so we definitely want to open it up to just questions, or let us know if you're working on something. We love to hear about deals that are happening right now or deals that you're.
How is the market in Atlanta? What are you guys seeing in terms of
That's a great question.
Mm-hmm.
So school started for us in our area last week and this week. What we're seeing is not as many offers coming in, but the offers that come in are really, the expectation is still there. Hey, the offers are strong, and the other agents are extremely willing to work with. I mean, it's just a really great balance we're in right now with the market.
Yeah.
But we're not getting the craziness of over, getting so much percent over list in 24 hours or something like that. We're going through the weekend. Some of them are now 10, 15 days on the market, and yet the sellers are holding out for their price, no doubt. And they will get it. They will get it.
So the volume has definitely gone down with the number of offers and the buyers in the market. So, there may be opportunity there for the buyers who have gotten some fatigue with competing so heavily. We're seeing some folks able to get, with some actual contingencies or loans or whatever, they're able to get properties now that they haven't been able to get in the past. But we're in. I know there's a lot of talk about the foreclosure moratoriums and what's going to happen, and just our particular area, I don't think will be affected by that. We're just in a pretty affluent area, and we don't anticipate that there's going to be a whole lot of suddenly foreclosures happening or major delinquencies where we are.
Well, yeah, and especially because we're in such a high in-demand school zone,
Yeah.
people have equity in their homes they never thought they'd ever have. So there's just really too much equity in that house.
Yeah.
To foreclose on it.
So, I've said real estate is highly localized. Yeah, I don't even like, I'm in the Washington DC market. I don't even like saying the Washington DC market is X because it's literally neighborhood to neighborhood.
That's
There
right.
can be a huge differentiation 3 neighborhoods over, just school districts. There can be, one has better access, could have a hospital close by. There's all kinds of different mitigating factors. And I tell people, it's like, look, you need to watch inventory and, what we're sort of feeling here and what I don't know. And one of the things is you look at this and you try to forecast, but you don't know. Nobody ever really knows. But what you're hearing is, look, May have been the high point because when it got to May, you saw stuff go on the market and there were multiple bids on everything. It was going for well over ask price. And now we had a flip that came on the market right after the 4th of July. It's priced very, very well. I would have sworn it's going to be a dogfight trying to get it under contract because there's going to be so many offers. First week came and went, crickets, nothing. We had people that were interested, didn't have any offers. Second week through, they actually adjusted the price. It went under contract. It's closing. It's still a really good ROI, but it's not what it was before. So the question is it a seasonal thing? People could go away for the first time in forever. July, maybe people are thinking about going to the beach. They weren't thinking about buying houses. Or is it a bit of a sea change? We don't know yet. But the only way you find out is to continue to watch inventory and stuff that comes on the market. Is it still there 2 weeks later? Did they have to adjust their price? What else has come on since?
Yeah, we're seeing the same exact thing. So, yeah. So, questions?
Any ahas? What'd you learn from this? I've learned a lot.
Hi.
Hi.
Hi. My name is Sandra. I don't know why it says Michael Hernandez. I think it glitched when the multiple entries. But I just want to say a quick thank you for you guys giving your time and your education in this space. This is actually my first meeting that I've joined. And so just a little bit of background because I do have a few questions. So I live in the Lawrenceville area, so Metro Atlanta area. And I'm a junior in college right now, but I'm very new to this whole investing thing, very new to everything that's happening. But the main thing that's on my mind right now is, and maybe you guys can give me some guidance or some tips, is I want to invest in some land out in like the, the Blue Ridge, LEJ area. Because I found a good deal, and potentially build a cabin or like a property on it. But obviously I'm very new. I don't know what all that entails. So, when you talked about like the land, construction loans, you were talking more about the flip and invest and flip. But do you guys know anything about new construction loans and what that might look like?
Sure. So here's the first thing that I would say on land. You've got to be able to find someone that you can trust that can give you a good gauge on the land use and the feasibility. Okay, because if you're out in the country, you're going to have to do a well and a septic. Okay, and there are some land that is, let's say it's heavily, there's a lot of rock underneath the surface. The cost to put in a well and septic, it either A, won't be feasible, or the cost is so much that they could give you the land for free and it wouldn't make sense.
Right.
Oh, okay.
So you have a piece of land that's worth $25,000 and it costs $50,000 to put a well and septic system in. Well, they could give you the land for free and it wouldn't be worth it because you can't do anything with the land. So you've got to be able to have.
Typically, those are called perk tests.
Yeah, perk test in some, if they already have that, if they've already done that, sometimes they can provide you that documentation. If not, you would certainly want to make your purchase contingent on it passing that, or you just wouldn't go through with it.
Okay, and I just have a follow up with that. So that all kind of happens once you've like reached out to that agent and you're interested in the land. And they kind of follow you through that process of like, what would that process look like?
So
Go ahead.
I was just going to say, if it's on the market with an agent, that would be a question I would ask, is what kind of tests have been done on the land? Has there been a perk test? Because like I said, they may have already done it. If not, then your contract, you would want to make sure that you had ample due diligence to be able to perform that, or you could put it back on the seller. I mean, I feel like the seller would have to have that if they intend to sell the land, but
But some people don't even want to deal with
they
it.
may or may not be willing to pay for it. I would start there. I would try to get the seller to pay for it. And if they won't, then that this might be a cost of you doing your due diligence, but you'd want to be able to get out of that contract if you weren't satisfied with that, right?
So all the investigation kind of happens once you get to that point. What I would say about the land that I'm seeing right now, it is under like an HOA with like one of those it has like the community it's the acre mountain area. It has like the tennis court and the pool. So I'm hoping maybe they do have that documentation.
Sounds like they might.
Yeah.
So let's say I get this land.
Okay.
My next step, right, would be to see if I can get a construction loan. How do those work?
Well, I think your next step would be finding, right? I mean, you would have to have a builder, right? I mean, you're not going to get out there and build a house on your own, right?
Yeah.
So go ahead, Chip.
Yeah. So one of the things you want to start looking at, if that's what your goal is to locate a builder and then work with him on sets of plans. And he'll probably have some plans that are stock plans and give you an estimate of what's going to cost to build that. And so what that's going to do is you're going to have a certain footprint for the building.
Right.
So you're going to have on your lot, there's going to be certain setbacks where that house has to be built 15 feet from the front of the lot. It has to be 20 feet from the side of any of the other houses. And it has to be, 25 feet from the rear of the property. So it's only going to allow a certain size house on that lot. So one of the things you want to be able to do is you come in with the footprint of your house and make sure it's going to fit. Okay. And your builder should be able to help you with that. And that's
making sure it's got value. Yeah, making sure it's got value.
Well, if it's in this type of community, I would start with finding out who's already built in that neighborhood, because then they'll kind of know a lot about what can be done. And I will say one of the challenges, not to discourage you, but one of the challenges you'll find in Blue Ridge, because it's been so booming, is just getting a builder to even, either you can't even get them to call you back, or their time frame is going to be, a year or more out, before they even start on the project, potentially. I mean, those guys have just been wide open with all that's happened during COVID, with all the demand. So that any area really in North Georgia in the mountains has been that way.
Okay.
Yeah.
Okay.
So you maybe want to start, even though you don't have the land secured, it's just feeling out some of the builders in the area, trying to get a feel for that.
And your builder may be able to point you to a financing source too.
Yeah, local bank that they probably already work with, right?
Right. They're financing their projects through somebody. And look, if you're going to occupy this property, which I would, even if your intent is to rent it out at some point, if you approach it as an owner-occupied loan, because you don't have a personal residence, it allows you to it opens up the gates to more financing types and better interest rates.
Okay. Yeah, it's good to know. Yeah, because I don't have I still live with my parents, and what was I gonna say on that? Oh yeah, and my plan would be to, once I do have this cabin, I would want to open it up to like short-term rental, like Airbnb space, and then, have it build equity and in some future, end up selling it. But I definitely do want to generate income off of it.
Cool.
Sounds like
Don't tell the bank that on your first conversation.
Right.
Yeah. That's I
And it's a good thing you're not buying an existing property, because actually that Blue Ridge area is one of the areas a lot of people don't realize you don't even need to have a builder's permit to build.
Well, no, that's changed, but like if you buy something older than
Yeah, it's the age. I'm sorry.
2005, it wasn't until
2005, which to me is still so new.
you actually had to have permits. So there was stuff built prior to that can be pretty
Suspect.
Okay, well, so either way, I need to have basically a builder in place that's willing to see like an estimate cost, and then you go to the bank, and that's where they see the financing they can give you.
Yeah.
Sandy, what's your major? You're a junior in college.
Business marketing. And I'm actually trying to also get my real estate agent soon. I'm doing the course right now, so I'm hoping to do that as well. But yeah.
awesome. Good.
Great. That's
Yeah, I go to Georgia State University in Atlanta.
Okay.
Yeah.
cool. All right. Anybody else? I hope this was helpful.
Yeah, thank you so much for the information. I really appreciate it, guys.
Yeah, good to meet you. Thank you.
Thanks, guys. That was wonderful. And thank you very much.
Michael, thanks for getting everybody logged in and for bringing all your brothers, Michael, and your cousins, Michael.
Yeah. Maybe you could...
Actually, I have a question.
Yeah.
So I am a real estate investor, but I do a niche form of investing. I'm actually a mortgage investor. I generally purchase underwater mortgages at a steep discount. And then I renegotiate them with the buyer, because as the premier lien holder, I have the legal authority to rewrite the terms of the original mortgage. And I am looking to expand this. And at some point in the future, I'm trying to figure out the best way to do that, which may include some alternate funding sources. And so I'd like to hear about different strategies about how a lender in your position could potentially work out deals with my particular business model. Because then I work out deals with the borrower or the homeowner to stay in their house and avoid foreclosure. So with the legal authority to rewrite their mortgage, I can set the interest rate, I can set the down payment, the monthly payment, balloon.
She's cut off on my end.
We lost you.
Oh no.
I think we got the gist of it though.
I think I got the gist of it. Do you want me to take a stab at that?
Yeah, please.
Okay.
So I know and understand that business very well. And there are organized companies out there that do just that on a large scale. And what they are doing is they're getting warehousing lines from certain banks. There's a couple banks on the West Coast that I know of, and they're essentially, let's say you're buying a mortgage for $100,000. The warehousing line will say, we'll fund 75,000 of that. You fund 25,000 of your own money. And then they are essentially putting a lien against the mortgage that she holds. Okay, it is not there. You're not going to find a traditional private lender that's going to do that, because they want to have a first deed of trust on a property and not a loan against a loan. But there are warehousing lines that are out there that it may take a little bit of time to get enough progress in the business to be able to approach those warehousing lines. But that is something that's done all the time. It's just probably going to take a little bit of time to grow your business enough to be able to approach those guys.
Hey, Chip, I know you put your contact information, I think, in the chat at the beginning, but since everybody had issue logging in, maybe reintroduce yourself, because I think most of the people on here.
Who are you, Chip?
Who am I?
Who are you?
So I'm Chip Sher. I'm the principal of it's 4SB Partners, and you can reach me at Chip at the number 4SBpartners.com, or phone number is 703-609-7616. And I've been in private lending for about 30 years. So I've seen a little bit of everything. I like to say I've seen everything once, most things twice.
Wow. Awesome. Wow. What, I can't remember her name that shared, but what a great value to offer someone. I mean, we had a client with a hard money lender. They missed one payment. They asked, can we keep this property? We'll just do anything. And they ripped it out of them and they were done. I mean, they lost so much. It was really tough. So.
Yeah, right wording. Going back to his advice about the warehousing lines, those are with traditional banks, right?
They're with very specific banks that are set up to do that kind of thing. Okay, so on the West Coast, I believe. So the name of the bank escapes me, but there's a bank on the West Coast that does that particular thing. And I mean, there's big businesses in and around it. And if you think about the commercial space, and a lot of the bigger commercial loans are on a 10-year balloon. You get to the end and the value has gone down, and the lender's either going to take the property back, or somebody comes in and says, "Look, I'll just buy your loan. You don't have to mess with it." And they'll buy the loan for a discount, and then the first thing they'll do is they'll put in a phone call to the owner and say, "Hey, this is your lucky day. I'm going to reset the terms with you, reduce your principal and the rate." And they're still making a really good yield because they bought the loan at a discount. So that is a niche within a niche. So inside the private lending space, there are folks that will do just that, and it's very specialized. It could be very lucrative, and there are bigger players out there that deal in the billions of dollars of that kind of stuff.
Right. Now, if I'm trying to find, I assume there's not like a list of different banks that specialize in this with those warehouse lines. So I just do a Google search, bank plus warehouse line, or which banks have warehouse line?
And it's not only that, it's a warehousing line to buy loans. Okay. Because you have certain businesses that will get a warehousing line, and that's upon their cash flow and their balance sheet and the capital they have, and the amount of money they have in the bank, all that good stuff. This is designed, it's not indifferent from buying property, but it takes a specialized source that really understands what you're doing to be able to put that into motion.
Okay, thank you.
Yep.
Good luck with that. Okay, thank you so much, Chip. This was awesome. Really appreciate it.
Yeah.
Anytime, guys. Anytime.
So just to remind everybody, if you want to connect with us offline, at the very beginning of the chat, we put our contact information there. So feel free to connect with us and reach out. If there's no other questions, we're gonna wrap it up for tonight. All right, guys. Enjoyed it. Thank you again, Chip.
Thanks, guys.
Thank you so much.
All right.
Bye-bye.